What is happening, my friends? Welcome to the exam breakdown. Today is May 28th. What? It's crazy. May flew by like fast. I'm always saying this stuff. Things are moving very quickly for me. Awesome. The summer for kids is almost here. I don't know if any of y'all have children, but it's coming, right? A few weeks for all of us. And that's going to be cool. We're going to see our kiddos a lot more. That'll be fun. What are your plans for the summer? I hope you can have some fun ones. For those of you that don't know me, my name is D. Kumar. Thank you very much for joining us. What we do here on the Exam Breakdown and on our channel, generally speaking, is we help our students to try to pass faster. The goal here is to get through your real estate examinations, broker, salesperson, principal broker, wherever you are, mortgage loan originators, which is what we're going to work on a little bit today, and help you get through those two particular sets of exams. I've been in the real estate space for a bazillion years. I've trained tens of thousands of people. We've grown our YouTube channel. Our students on YouTube are passing just with the content that we're putting out there, and it's phenomenal. Congratulations to all of our recent graduates and students that are passing and getting their licenses and moving on. And to those of you that are still working towards that, fret not. We are here. We are here to help. The goal is to try to make you understand different topics, get different sort of angles of approach, understand how questions might be brought, question analysis, vocab, and understanding these concepts. I've trained from virtually every publication across the entire spectrum of real estate, whether it be finance, whether it be investments, whether it be brokerage, whether it be exam prep, and I've learned a lot. I've been in physical classrooms. I've trained thousands of students. I've been with them. I've helped all of these people get through this exam. Think of it this way. Every single time to me, it feels like I'm in that room with you. I'm in your head. I'm trying to get you through this thing and trying to figure it out. So I've experienced this exam, if you will, thousands and thousands of times. I've experienced all of these tests. Nothing intimidates me. I know the chief reasons why a lot of people don't pass. I know the chief reasons why a lot of people fail. Patterns repeat themselves, and it is my goal and my team's goal to help basically with this stuff. And today what I want to do is I want to go through some mortgage stuff. Let's jump into it. We're about to drop a really, really helpful 20 questions for the mortgage originators. It's come highly demanded. And one of the most popular videos that we have actually on the channel, and I'll take you there. If you just go to at D. Kumar Online, YouTube, or you can even search any search engine for D. Kumar Real Estate or something, and you'll find us. And thank you guys very, very much for subscribing. If you haven't really considered doing that, there's a lot of information here, and there's a lot of stuff that we're going to be delivering in the near future that goes above and beyond exam prep. And so, you're going to want to stay tuned in. We do certainly have videos and all kinds of help here. There's a lot of videos for real estate examinations, but I wanted to show you on our, one of our most popular videos is this NMLS flashcard video. There's about 100 NMLS vocab phrases here. And then another one super popular is this one here, the NMLS exam practice questions, the MLO test prep for 2025. Super popular, very, very effective, 25 questions. And someone might say, hey, it's only 25 questions. I need 25,000 questions to pass this. That's all nonsense. You don't need 25,000 questions. You need like 25 great questions. You need someone that is a technician that understands, what the high probabilities are on exams. You want to understand how, from somebody that basically writes questions and understands questions and analyzes and explains things to people. So it's really my targeting system that's really, really effective. I don't have a copy of your examination, but I can sure bet you if I'm looking through anybody's materials, I can identify the highest probability stuff and the possible ways that the exam writer is going to bring it. And that's sort of one of my talents is to be able to do that. And I work with the team. Kato Fury is one of the the generators of the materials, and we kind of work together. We go across everything that's happening in the industry and try to figure things out, and we sort of present it to you. So that's sort of where it's coming from. It's coming from a lot of practical experience doing this stuff. So I'm here to help. My experience teaching goes across many, many different modalities. I'm a geek when it comes to teaching. So my teaching techniques, there's things that I do by design. There's things that are intentionally done to help students get through stuff. I get hired to do enterprise level training, and I'm brought into organizations that are trying to license their C-level suite executives many times, trying to figure out how to move them along the ranks and stuff like that. It could be lateral moves. It could be them anticipating that they're going to another organization. And my job is to take someone that hasn't been in a classroom for 30, 40 years and teach them how to pass an examination and get through it in the most efficient way possible. And we distill that down here for our friends here on YouTube. So welcome. If you're new, consider subscribing. Maybe I can turn you your opinion at the end of this. So I'm going to work for you for a couple minutes. And today I want to go through the mortgage origination stuff. What I want to do is I want to go through and talk about a couple of questions here. And I'm going to bring these up. I'm going to go through about 5 questions. We're about to drop a 20-question series for the mortgage folks. And this is just a sample of that. So I'm just going to give you the first 5 and kind of walk through them with you so you can kind of understand what it's going to be like. And then you're going to see this 20 questions drop pretty soon. And you'll be able to work from this as well. So, you'll have more questions for the mortgage folks, which has been, requested in the recent couple of months. And so, here you go. Let's jump into it. You can follow along if you want to. You can check it out if you want to. You can ask questions if you want to. Congratulations to all of our recent folks that are passing. And I really want to also just say thank you to the folks that are having difficulties and are brave enough to tell us that they're having some troubles. It's really hard, to explain to people that you're having difficulties with things, despite the fact that you're hearing so many or seeing so many comments about people's successes. And as it's wonderful to read the successes, right? I applaud them from cheering from the rafters, but I also understand that people are still failing. And, again, congratulations for being so brave. You have to acknowledge failure before you can achieve success. And so I'm proud of you at the fact that you would bare your soul to a bunch of random strangers and explain that you're still having difficulties. So thank you. Keep those coming, please. We will be, a shoulder that you can lean on. We will give you a response. We will try to keep you motivated and move you through. And it is so exciting. Nothing really, really pleases us more when we hear the comments about people passing. But when we do hear the comments about people failing, we also are really appreciative, and we hear you and we want to help. All right, so question number 1. Under HOEPA, the Homeownership and Equity Protection Act, which of the following is a high-cost loan trigger? Letter A, APR exceeds the APOR, which, by the way, stands for the average prime offer rate, by 1.5% for a first lien mortgage. Letter B, the borrower has a DTI ratio exceeding 50%. Letter C, the loan has prepayment penalties beyond 36 months. Letter D, the borrower's FICO score is below 600. And the answer? Oop, just jumped. Hey, take it easy there, dude. Sometimes this tech, I don't want to bash on it, but it's the application, the Notebook Pro app. Sorry, guys. It's buggy. All right, so answer is letter C. The loan has a prepayment penalty beyond 36 months. The number one, a couple of answers that kind of stood out for me. The reason why I like this question is, first off, you want to be acquaint yourself with what HOEPA is. Let me just grab a color here really quick. Boom. Let's do this, and we're good. All right, so the first one, letter A. The APR exceeds the APOR, so you're going to definitely want to know what the average prime offer rate is, and there's a trigger here that you're going to learn in your materials, no matter where you're taking the pre-licensing course, if you're doing this. And you need to know what the triggers are. Now, this was a high-cost loan, and many students will confuse higher cost versus a high-cost loan. Now, Home Ownership Equity Protection Act is also known as a Section 32 loan. Section 32 loan, if you look at Section 32 of the Truth in Lending Act, you will find the Home Ownership and Equity Protection Act, HOEPA. And so Section 32 of the Truth in Lending Act is where this thing lives. So it's a law, if you will, inside of a law, right? A law inside of a law. Section 32 addresses high-cost loans. Now, in our world, we have prime loans, we have higher cost, and then we have high cost. Right? If you just look at it from this like simplistic understanding. And so prime loans are loans given to the most qualified borrowers, right? The traditional loans that go to them, and we look at the ability to repay, and we look at the qualified mortgage rule and all this other stuff. And then there's higher cost loans. An example of a higher cost loan might be a jumbo mortgage, just because of the loan size. It's like an economy of scale, sort of, right? Like, so like the costs associated with a larger loan could be how you might have to get 2 appraisals, for example, just as a higher cost. You might be paying an origination fee that is larger because the origination fees are based on a percentage of the loan amount, right? So I mean, 1 point on a $5 million loan versus 1 point on a $50,000 loan. Now, the opposite end of the spectrum is also something that you want to understand. You know, if I were to ask you, which type of loan would you rather originate? Would you rather originate a $50,000 loan, or would you rather originate a $5 million loan? I'm going to tell you, all loan originators, I bet, would be like, unless there's no profit motive, I'll say that. And maybe there's a volume motive, right? That's okay to get compensated on volume motives. Right, if you look at your loan originator compensation rule. And so like $50,000, the profitability is very small, right? You're not going to make anything. You might make a couple $100. And so like there's a disincentive to originate smaller loans. And so like you're not serving a large percentage of the population if you're not originating loans. And if you call 9 out of 10 originators, they're going to say, no, I don't do $50,000 loans. Our minimum is $500,000, even though they're not supposed to give you a minimum loan amount. They really don't want to deal with a $50,000 loan. So they kick the can down the street, if you will. And so like, then how do you incentivize someone to do it? If it's not volume based, well, then you need to pay them appropriately for the work and time, because a $50,000 loan is the same amount of work and time as a $5 million loan, right? So like it's in terms of work, it's the same thing. And so when you have that disincentived action based off of the compensation triggered by percentages of yield, then you're going to have to come up with a motivation to motivate an originator to write this loan. And so these high cost loans are something that do exist. And so they're called Section 32 loans. Now, a lot of loan companies won't do them because when you're talking about charging more fees beyond what's typically normal with qualified mortgages, well, then the big P word comes up. And that big P word is something called, let me just pop over here, it's called predatory lending. And predatory lending is this fear thing that most originators and lending companies don't want to deal with, because we have so many consumer protection laws that are helping consumers fight back against predatory lending. And so you need to know what HOEPA is. You need to know the difference between prime, high cost, and high loans, higher cost and high cost loans. You need to know what the triggers are. And this is a trigger for a higher cost loan. The 1.5 for a first lien. It's 6.5 and 8.5, by the way, for a HOEPA trigger. And then the prepayment penalty is the HOEPA trigger. If a loan has a prepayment penalty that is exceeding 36 months, most programs have no prepayment penalty, by the way, but some can. On a high-cost loan, there might be. And if there is one, and if it exceeds 36 months, then it's a HOEPA trigger. So under which of the following is a high-cost loan trigger if the prepayment penalty exceeds 36 months? And so that is the trigger, not letter A, which would probably have been the number one wrong answer. Let's go to question number 2. Good question. Anthony, a 17-year-old applicant, applies for a loan, but the creditor denies his application based on his age. Has the creditor violated the Equal Credit Opportunity Act, the ECOA? The answers: letter A, yes, because ECOA prohibits discrimination based on age under all circumstances. Letter B, yes, because creditors cannot consider an applicant's age when making lending decisions. Letter C, no, because ECOA only protects applicants based on age if the applicant is of legal age to enter into a contract. And letter D, no, because age is not a protected class under the ECOA. And the answer? Boom. Letter C, no, because ECOA only protects applicants based on age, subject to the applicant being of legal age. Like a little asterisk here. To enter into a contract. And so the legal age to enter into contract, or contractual capacity as they call it, is typically 18 in most jurisdictions. and therefore Anthony, being a 17-year-old applicant, would not be protected by the Equal Credit Opportunity Act. Your age is protected. So letter D, no, because age is not a protected. Age is a protected class under the Equal Credit Opportunity Act. You definitely want to know. You definitely want to know that definition. Just checking out. Oh, I wanted to congratulate. Kate was texting me to just congratulate Charlie. I guess Charlie was just a recent pass and super excited. So congratulations, Charlie. And I think there was like a student named at Amanda 44 something or other that's taking their test. So congratulations, Charlie, and good luck, Amanda 447, on your attempt. You got this. Okay. I also have a private that I got to jump to in a little bit, so I might have to cut this just a wee short. I'm going to try to get through as much as I can, but I think the deep dive analysis is really going to be helpful for you guys. So I'm not worried about the quantity of questions. I think it's the quality of the analysis, because a lot of students make microscopic mistakes, and that's why they're failing. It's a game of inches for a lot of students. It's not the overall theory of what this stuff is. But as you can see, we get into the weeds with these questions, and I would suspect that an exam writer on the real exam is definitely getting in the weeds here. We can easily cut to 50-50 because we can say, is this a violation? Is age protected? And if you understand your protected classes, you can eliminate A and B, which gives you 50-50, C and D. And then D was kind of like an easy one to say, well, that's not true, as long as you knew the protected classes, so you want to memorize those, and letter C is the answer. Next question. Question number 3. What does the acronym SAFE in the SAFE Act stand for? True story. I was once at a conference when the gentleman that wrote the original SAFE Act was sitting right next to me. I'm like, whoa, that's crazy. He just kind of like, he was explaining, he just kind of went to an empty cubicle and penned it out. I was like, oh, good for you. That's insane. All right, so question number 3. What does the acronym SAFE mean in SAFE Act? Letter A, Secure and Fair Enforcement Act. Letter B, Secure and Federal Enforcement Act. Letter C, State and Federal Enforcement Act. Letter D, Safe and Fair Examination Act. Safe and fair examination. The exam is safe and it's fair. And the answer? This is easy. Letter A. And you, by the way, you want to know this one. This is a pretty simple one, so I would suggest that you definitely know this one. You're also going to want to know the SAFE Act penalties for violating the SAFE Act, and what are the grounds for violation, right? You want to know those pieces. And you typically will see those in the uniform state test content. In the majority of states that have adopted that, you will certainly see some reference to that. Question number 4. Where do mortgage bankers get the funds to originate mortgages? Letter A, by using their own capital and credit lines, then selling loans to investors. Letter B, by collecting monthly payments from borrowers and reinvesting the funds. Letter C, by pooling money from depositors like traditional banks. Letter D, by directly issuing government-backed loans without third-party involvement. And the answer? Letter A, by using their own capital many times and credit lines when then selling loans to investors or secondary market players. And so typically mortgage bankers are getting funds. There's a phrase called a warehouse line of credit. And many times that's where lenders are getting their money from. They're borrowing it against the spreads of the money markets. They're lending it out, and then they're getting their money back by selling it to secondary mortgage markets, which is why a large percentage of loans that are originated are coming from the conventional loan markets, the conforming loan markets, because they can sell to Fannie and Freddie, and then they can get their money back. So that's really the way that this is done. You want to know primary and secondary mortgage market. You also want to know a little bit about who the secondary players are, like Fannie Mae, Freddie Mac, what they stand for, and things like that. But this is typically the way that most banks are getting their money. Oh, right to 19. Look at that. All right, let's see here. Hang on. Number 5. As you can see, they're good questions. All right, let's do this as a wrap up. So question number 5, the Fair Credit Reporting Act, the FCRA, is also known as letter A, Regulation X, letter B, Regulation O, letter C, Regulation V, letter D, Regulation Z, or Z for my folks from across the pond. And the answer? Regulation V, letter C. All right, so you definitely want to know these regulation letters, and these are implementing the various laws. So like, for example, Regulation V is for the Fair Credit Reporting Act, the FCRA. Reg Z, I'm sure many of you know as TILA. TILA is the Truth in Lending Act. So you want to know how these play out. The classic one that you're going to see for here, Regulation V, is think of V, if it's a Credit Reporting Act, think of V for Visa, like the credit card, and like Regulation V, V for Visa, it deals with credit. Credit is the Fair Credit Reporting Act. Then underneath the Fair Credit Reporting Act is something called the FACT Act, or FACTA, which deals with identity theft. So any questions that you get on identity theft is the FACT Act, which is a law, again, inside of a massive law, just like we saw earlier with the Truth in Lending Act and HOEPA, which is a law inside of a law, Section 32. And then with this one, it's FCRA and FACT Act. FACT Act was written in the 2000s to address identity theft, and so it's a piece of the Fair Credit Reporting Act that specifically dismantles and understands and deals with and enforces identity theft and deals with those kinds of things like red flag rules, etc. So you want to know how all of this stuff kind of interplays. It is certainly some stuff that you will see on exams. All righty, Rooney. That was cool. That was like a quick, just, hey, this is what it's going to be like. As you can see, the questions are pretty solid. It always pays to get a deep dive and analysis to understanding why. Really, you don't need a lot of questions. You just need to understand what's going on inside of the questions and like sort of lift the hood up. And many times it helps tremendously to have a technician that's just kind of speaking into your ear, explaining why and what to think about tangentially, right, to the question. So like with Regulation V, for example, we jumped in a little bit. I talked about FACTA. There was no question about FACTA. And so like many of you guys might not be drawing those two conclusions. And that's really where the conclusive like lattice work is when it comes down to it. You should always consider going to a pro before you take exams like this, because if you have failed or you're failed recently or you're sitting there, mortgage originators, you failed the first time, you've experienced it, but now you got to wait 30 days, it takes a technician to really help you out. Now, many times I see people really, and maybe you're not in the financial position to be able to afford that, but it is worth its weight in gold if you work with it. Eons ago, back in the day, we had the SATs. And we had two different distinct pieces of it. And I remember taking the Princeton review courses to help brush up on understanding my reading comprehension, my English comprehension, and my math. And so like taking professional help, even though I could have just bought a book and like kind of read through it. There's some people that can certainly do that. And then there's a lot of people that cannot do that. And so like my suggestion is that you consider upgrading the help. The course providers are good, but sometimes course providers aren't great teachers, and that's another problem. And a lot of canned courses is great for convenience, but they're not really great when it comes down to understanding how these things work. This just takes some experience and some understanding and the ability and the passion to really want to teach people and to give a rip. So it's wonderful to take a course that's canned, but it's also more wonderful to understand that the logic behind that course and sort of what goes into it is logically planned out for people to have the highest level of success. I wish you success in your endeavors. Thank you for the time you spent with me today on the exam breakdown. I hope it yields you some success. Good luck with your studies and good luck on your tests. I got to bounce. I got a private that's about to start and I got to work with them to get them through this exam. Alrighty. I will see you very soon. Typically Mondays and Wednesdays are when we go live for the exam breakdown. We've got some great stuff coming out pretty soon. New videos are dropping on different concepts and different content. You're going to love this stuff. Please, if you found some value in this, consider liking and subscribing. If you are a subscriber and you're checking us out, share. Let other people know about it. We are on our way to helping more and more people, and that only happens is if you feel like you're getting value and that you tell other people to consider subscribing to our channel. Thank you very much for all the support, and we'll see you in the next exam breakdown. Be well.